Yes, it's always nice to expect a downtick, but when the downtick happens, you have to be mentally prepared. It's always a tough call, right?
Right. Absolutely. Mihir, but has anything changed between, say, day before yesterday and today with the way you will be approaching the markets as well and in your ongoing journey for creating wealth for the investors through your funds?
Sure. So I think broadly, the long-term picture has not changed, and we have seen, statistic after statistic, and the returns that we've seen over the longer term. It really is not correlated with which kind of government has led India, and we've seen growth, good and bad phases in various kind of situations. So I think India has a momentum of its own. So the long-term story, frankly, does not change. What can change from time to time is the sentiment towards certain parts of the market. And I think the good thing about the verdict yesterday is that there is continuity of regime. So a lot of bets were on the growth path continuation, investments in terms of physical assets being given priority by the government, and private sector participation in various manufacturing, etc., infrastructure, etc., projects being encouraged. So I think that's not going to change. The minor change I think that can happen is that it looks like there was some element of rural voting pattern that has come out, and we have been saying that the recovery in the last couple of years has been a bit of a K-shaped, and to that extent, the lowest rung of the voting masses probably have not been that comfortable, and the economic recovery has taken a longer time than expected to reach the lowest rung of the spectrum. So to that extent, I think what you can see in the new setup is that you might see at least more than before a focus on the lowest rungs of society in terms of social support, economic support, etc. So my guess is that the markets are also looking at that. The verdict, seems to indicate that, and that's the reason why we do see that there is a realignment of the performing segments in the market over the last couple of days, where you might see that some of the K-shaped recovery will be addressed. So I think the markets and some of the portfolios that we are handling are also kind of adjusting to that probability.
Right. So, Mihir, since you're saying that the focus will be on welfare schemes, perhaps rural spending will probably be the key focus area of the new government that will be formed now in days to come. Will that mean an increased focus on sectors like FMCG, consumer staples, rural economy, autos with the tractors as the main focus? So something which is in focus towards the rural theme, is that something that money will be made in the next few months?
See, that's what the markets are expecting. So if you read most of the strategists, investments and broker reports yesterday, last evening and today morning, most of them are of this view, and I guess the market's also reflecting that. But my guess is that it may or may not be direct, it may be indirect, but the fact that this has become a focus point itself is good enough for some kind of a re-rating in the markets.
Okay. Mihir, I'm just looking at your newly formed portfolio for Trust FlexiCap Fund. You have about 550 crores with you, and this is a very, very well diversified portfolio. The top 10 stocks account for just 12% of the overall asset under management. Of the shopping that you have done probably yesterday and definitely today morning, have you added any new stocks, or have you added into your existing portfolio of stocks?
Actually, the portfolio probably you are referring to is the initial portfolio, which was just formed 3 or 4 days after the fund was launched. So the May end portfolio is far more invested. We were more than 90% invested as of May end. Okay. And because we had promised investors that we'll take about 2 to 4 weeks to invest the funds that we collect, which is what we have done. So as of May end, our biggest overweights were basically in the industrial space, the physical asset creation space, as I call it, where we are talking about the focus areas, which is infrastructure, capital goods, real estate, utilities, those kind of stocks. That's where we were the maximum overweight on. And then, of course, stocks in the consumer discretionary space, which is more of the premium end consumption like and some of the tractor stocks, etc. So we were more, I would say, pro physical asset creation in our tilt. And of course, that while that theme broadly continues, we probably might need to rejig the portfolio a little bit in favor of the lower end consumption as we discussed.
Okay. Does it mean, coming back to my original question, for whatever is the existing number of stocks and the names that you have already in the portfolio, by any chance did you add a fresh name yesterday because of the sharp fall in the markets, or was the purchasing limited to the existing portfolio?
Mostly buying and selling yesterday would have been in the similar names, maybe a name or two here or there, but nothing major, I would say.
Okay. Also, the fact that today has seen an equally good run up, whether this is a dead cat bounce or whether this will be further purchased into, only time will tell. But what hasn't moved is the former, how should I say, market darlings in the large cap defense space led by PSUs, and a vast chunk of PSUs as well. What do you think? Is that love affair with the PSU basket over, and you will have new leaders emerging in to take the bull market forward, or people are just waiting for the cabinet to be formed?
I think both. I would say both, because on the positive side is the same government. The policy continuity is likely to be there. But on the other side, as I said, the markets may be discounting some change, a little bit of rejig of priorities of the new regime. So to that extent, given the fact that some of the stocks and sectors that you mentioned had gone up a lot in the last 6 months, probably also made a case for a valuation based call also. So I think it's a combination of all these things. That's why we are seeing this rejig in the market.
Okay. Now, Mihir, the other point that I wanted to ask you is that how would you advise investors to approach their portfolios which have bled through last evening, and some of them may be sharply down even today as well? What is your key advice to them right now?
Key advice, first of all, don't look at yesterday's returns. Look at 1 month, 3 months, 6 month, 1 year, 2 year, 3 year returns. And if you just step back and look at those numbers are still very good. So I think the wealth creation story of the Indian stock markets has not changed. And volatility is a inherent nature of this asset class, whether we like it or not. And that's the only way to create wealth. So we always advise investors to stagger their investments, whether it's through systematic investment plans or systematic transfer plans. And you should stick to that. There is no change in that recommendation.
Okay.
Sakshi, what's really interesting, we've prepared a chart of the Sensex in which we show the last 7 major corrections beyond 7%, and how much time did it take for the market to recover that minus 7% or 11%.
Okay.
And what happened beyond 3 and 5 years. I'm requesting the PCI to fire that. It's a very educative kind of a chart, and it shows how markets post a knee jerk remain quiet for a while, but eventually that is recouped. That chart will come in front of your screen. Yeah, there it is. So the latest was in March of 2020, 8 and minus 13, and minus 13 was recovered in 3 days. Look at that. I think we'll recover minus 8 in 2 days. So that's how it is that a knee-jerk volatile reaction does not end a story of a major economy, and of course it does not end the bull market. You can have newer horses and bulls leading the bull market, but it remains somehow in place, and it is for deep-pocketed fund managers such as Mihir Bhai to sort of buy into this knee-jerk reaction. Sakshi.
Right. So, Mihir, like Shell said, which are going to be the driving horses of this new setup that will be coming in now? And over the long term, where do you see outperformance really coming in from now?
Certainly. So I think the broad thesis of being overweight on physical asset creation will continue. Because very clearly, if we are to grow at 7 or 8% in terms of GDP growth, there is no way we can do it without physical asset creation. consumption alone will not drive GDP beyond 5.5%. We need to manufacture and create the infrastructure to manufacture stuff within the country, and that's been the focus of the government. So I think while we may talk about being more overweight or less overweight from time to time tactically, the fact that we will remain overweight on physical asset creation, that continues. That's a long-term thing, because there is no way that we can even think of catching up or matching China in terms of growth unless we create those physical assets required. So that's one very clear theme. On a more medium term or a shorter term tactical observation is that financials, the banking and financial space has underperformed for quite some time. And if the economy does grow, and which is what we hope, then I think the banking sector also cannot underperform for too long. If you look at the very long-term returns, 5, 10, 20 years return, the banking index has outperformed the Nifty and the broader indices. So without financial services growth, you cannot have GDP growth, and the sector has underperformed. So to that extent, in the next 1 or 2 years, we might see again the financial services sector also catching up. So physical asset creation and financial services sectors should continue to dominate. However, the relative, I would say, the relative positioning of some of the stocks that we saw rally very hard in the last 12 months may mute down. So to that extent, you might see the underperformance that we saw in FMCG and auto may not be that sharp any longer, and we might see some catch-up.
And that's exactly, Sakshi, what's happening in the markets. The Nifty FMCG index, if you look at it, is on a tear. I think the last time I checked, it was up 4.5%. Let's see what the gain is at this point of time. It's roaring at 5% higher. The auto index is 4% higher. Remember the rural theme of, bikes. I still remember a statement a long time ago. A friend just like Mihir had mentioned that, you can't keep a 19-year-old rural guy too far away from a motorcycle for a longer period of time. Good monsoon, the moment paisa aata hai fasal ka, the first thing that is purchased is a Hero Honda bike. In that time it was Hero Honda. Now, of course, it's Hero Motors, but still.
You never know, now it's smartphones.
See, smartphones to aajkal sabhi ke paas hain.
Yes.
I don't think so there is a youth in the country who does not have a smartphone at this point of time. He may or may not have a bike.
Yeah.
So, the first consumer discretionary purchase is a phone. In fact, 7, 8, 10 years old have smartphones better than mine. So that's how it is. But within the auto space, Mihir, what looks good? You mentioned a tractor company, something that you have preferred since the portfolio was set up. Four-wheelers, two-wheelers, tractors, SUV makers. What would you prefer for the rural theme?
I think for the rural theme, tractors and two-wheelers are the exposures. Essentially, as I said, the two-wheeler segment has not grown to the extent that the car segment has, for example, in the last 3-4 years. In fact, two-wheelers overall sales are just about what they were 3-4 years ago. So there is some headroom and a catch-up to be done in terms of the penetration, etc. But to that extent, there is a case for those kind of stocks in the portfolio. And valuations, of course, because the sector has not performed for quite some time, valuations continue to be relatively more attractive than the rest of the segments. So that's definitely a rural play there.
Okay. Let me ask you a contra question, Mihir. Where is there absolutely no space for a particular sector in trust mutual funds flexi cap scheme?
We don't have any negative list, frankly speaking. But typically, we are growth investors. So we prefer to see earnings growth visibility before we, like the stock. Then, of course, we test for valuations, etc., long-term growth path, valuations, etc. But we just would be averse to buying stock which are cheap just because they are cheap. So if they are cheap, good. But first, we need to see that earnings growth is visible for the next few years. So that's our first litmus test. So typically, we have been underweight on a lot of the stocks in the commodity segment, in some of the stocks in the energy space, refining space, etc. marketing, oil marketing, because they are cheap by normal standards, but the visibility of earnings was not that clear to us. A lot of the energy, materials, metals, mining stocks, we tend to be underweight because of the lack of earnings visibility.
Okay. So where exactly do you see earnings superseding returns coming in going forward from here? Q4 has largely played out largely in line with expectations. No very big surprises came through. Going forward after a month and a half, when we will see the next set of earnings coming through, where would you be really looking at?
If the economy continues to grow the way it is, then we would tend to continue with the same things, maybe a little more or less underweight than before. But the things that we do like are basically all linked to one is consumption, especially premium and consumption, that we will continue to hold. Then we have physical asset creation as one big theme, as I said. So those things are the ones more domestic, I would say, in nature, that we like.
Okay. And Mihir, apart from the earnings as well, there's one factor that you did talk about, that you do not have any negative list. But within the market cap band, how are you looking at the small and the mid cap space, which was being seen as a very frothy space? Now we've seen some correction come in. Are they looking okay to you with the current valuations? Is some more downside to go before they become attractive again?
Some of the stocks, of course, have not fallen that much. So to that extent, there might be some more correction, in some of the stocks. But the thing is that if you look at the top 250 stocks, which is large cap and the next mid caps, then the tail is very long. So you can't really make a broad sweeping statement that small caps are expensive, because there is hundreds of stocks out there from which we can do stock picking. And if you notice, even before yesterday's correction, a lot of the stocks, for example, in the chemical space, in some of the auto ancillary space, in some of the commodity space, had corrected in any case, even before this correction. So there is always scope for stock picking because the universe itself is so large.
Mihir, nobody was talking about this very obvious slowing of earnings growth that we are seeing over the past 5 quarters in maybe the frontline 100 counters, because people were gung ho, Modi 3.0, 400 par, ab ki baar na jane kya kya. But somehow, at one stroke of the market, now all these things that were in the background have come in the forefront. So when you look at Q1, when you look at Q2, which should be there over the next 5 months or so, what are your expectations maybe from Nifty companies only in terms of APS growth?
So for the Nifty, we are expecting about 12 to 15% earnings growth for the next couple of years. Okay. And within that, of course, there will be outperforming sectors and underperforming sectors. So to that extent, we are okay, looking at the current valuations and the current situation. Nifty as a whole, I would not say is very overvalued.
So that's a fine point. I think the forward P is somewhere like 22, 23, nothing to be worried about. I mean, those
lower than that, yes, probably lower than that.
Yeah, the days of 27, 28 PE still haven't come. So thankfully, at this point of time when this major hit has come for us, we are more than adequately, how should I say, moderately valued, and that's a big relief. यही 27-28 PE होता तो पता नहीं कहाँ बाजार नीचे आता. So that's a safety net that we have in place. Coming to mids and smalls, Mihir, anything that you would avoid with a barge pole, sectorally or even maybe stock wise?
Sectorally, I would not, say that, but for us, as I said, the two tests are growth. But even before growth, I would say it's the promoters and the management.
Okay.
If we are not comfortable with the background of the promoters or management, then it does not matter how good the sector is or how good the stock is. We would not go into that, because ultimately you do not want to, be with someone who you don't trust completely. So governance and background of the promoter comes first. Growth comes second. And as I said, unless we have a clear view on the growth path for the next 3 to 5 years, especially in the small cap space, we would not really go in for that, because getting in and out of small caps is not that easy. So we need to be doubly sure, and we need to have a very clear view on what we are betting on for the next 2 to 5 years.
Okay. Well, last word from you. How are you looking at the internet-based stocks, Mihir? Has that shown you any promise in the recent earnings? Will that be on your top radar going forward for your funds?
I think it's going to be an exciting space, and we can keep debating valuations. But the fact is that these are growth sectors. So at a certain valuation, these stocks do offer, an attractive entry price, and this is because in a lot of these cases, it's come down to 2 or 3 player market, and the markets are consolidating, especially now that PE capital and VC capital to burn is less easier to come by than say 1 year ago or 2 years ago. You will see this instinct to burn cash reducing, and in the listed companies, we have seen managements have reduced the cash burn and come up to terms that you ultimately need to show profits also. So if the path to profitability is visible, then even if the company is not profitable currently, we would be okay with that, as long as the strategy is to be profitable in the visible future. So that's one. And second is, as I said, since it's become a 2 or 3 player market in a lot of these cases, you cannot ignore the network effect. So because a lot of these companies have millions of customers onboarded, they have the ecosystem, and there's a network effect also that goes with it. So I think these companies are difficult to replicate. So to that extent, at a value, definitely these companies should be in the portfolio. And I would say that we've only seen 5, 7 big companies getting listed in the last 2 to 3 years. But I'm sure that in the unlisted space, there are a lot more of these companies which will come in the next 2 to 3 years. So this is something that we need to be aware of, because these are companies which are creating new business models using technology, and even disrupting existing businesses using technology. So they are change makers, and we are sure that we can find some good stock in this space.
Absolutely. No better stock to show than Zomato. Sakshi, it's very, very interesting and educative to check the low of Zomato yesterday. It was 145, 146 rupees. The stock shut at 172 and is now about 5-7% higher. This is a weekly change. If you show the daily chart, it will be up. And exactly what Mihir says, duopoly in place, the path to growth and profit is in visible, and of course it's a growing market. Not that Mihir how should have I wish he would say that he's bought that in the portfolio, but I'm sure he won't. But this is the best stock to show in the framework that Mihir looks forward to. Thank you so much, Mr. Vora, and we'll meet again shortly in Mumbai. Here's wishing you all the best for this newly formed fund that you are running, Trust FlexiCap Fund, and we hope you do phenomenally well for your newer investors. Thank you so much for your time, ladies and gentlemen. The story on Market Masters continues, and the next man in is perhaps India's most well-known face. Mr. Samir Arora joins us shortly, and after him, the parade of names continues. Mr. Vijay Kedia, Mr. Sandeep Tandon will be following. Mr. Samir Arora, the founder and fund manager at Helios Capital. Stay tuned to Market Today. It's a very, very interesting day so far.
Faith they've shown 3 times in a row. This is now the 4th blessing, and of course I will do my best to be worthy of that trust and to serve them well. I might add that while the